As a bank that focuses on business, we work with business leaders all day, every day. We have a front row seat to what's working and what has potential. The First Business Bank podcast is dedicated to sharing insights to help you work better, smarter, and faster to achieve your goals. Let's get into the show.
Hello, I'm Mark Malloy, CEO of First Business Bank. Welcome to the First Business Bank podcast. Today we're talking about employee stock ownership plans, or ESOPs. It's something that seems to be talked about a lot, but occurs much less often. We'll talk about why that might be the case. And nonetheless, ownership transition is an important topic these days as baby boomers age into their retirement years. Our experts will share some simple tips and their perspectives about ESOPs and if they might make sense. I'm joined by three of my colleagues who spend much of every day at First Business Bank working with clients on planning for transition on both the sell side and the acquisition side. They're each going to introduce themselves before we get our conversation started. Diane?
Yes, thank you, Mark. Diane Smith, Vice President, Commercial Lending.
Tom?
Tom Dott, Senior Vice President, Commercial Banking.
And Chris?
Chris Darian, Senior Vice President of Commercial Banking.
So Tom, I'll start with you. What are employee stock ownership plans?
Yeah, thanks, Mark. Employee stock ownership plans are really a way for owners to sell their business and transition it to the next generation, for lack of a better term, with the goal of incenting employees for staying on, creating a benefit for them, and in some cases, allowing themselves to stay on as part of the management team.
Chris, why would an owner or a group of owners consider transferring their business to an ESOP?
Yeah, it's a good question. I think it's becoming a bigger and bigger topic as, the succession plan topic in general is talked about, and business owners are looking for an exit strategy and determining, what is the best path. Obviously, from a financial standpoint, looking to an outside private equity firm or other potential acquirer could yield a better return for that owner. But if you factor in some of the tax incentives that are involved for both the owner and the business itself to transition to an ESOP, that's becoming, and has always been becoming a more popular point of discussion. So, it goes back to, what does the individual want? What does the owner or the group of owners, what are they looking for? If it's really, if the culture is important, if it's the sustainability of the employee base, if it's retention, everybody's a part of this company, then it's something to explore, and it's worthwhile, and it can be beneficial long term for the company, beyond just the short period of time.
Sure. Tom, what should business owners keep in mind if they're considering forming an ESOP as a way of transition of business ownership?
Lots of things. It generally needs to start with a feasibility study to determine, does this even make sense for the company financially, given the size of it? Does it accomplish the goals of what the current owners are looking to accomplish? Some of the things that Chris mentioned about maintaining legacy, employee incentives, those types of things. But then also they need to be thinking about, as a selling owner, what are their goals? What do they want to get out of this? And what are their plans going forward? And people should also be thinking about and understand that this takes a lot of time, not only up front, but ongoing and post-close. There's a lot of maintenance and reporting and those types of things, as well as educating the employees. And so there's a lot that goes into this. And I would tell you from my experience and from what I've heard from folks who have gone through this process, kind of from a post-transaction perspective, I think there's a lot of things that they wish they would have taken a little bit more time to better understand on the front end as it relates to, things like cost, what their time commitment is, and those types of things, where not that they wouldn't have still done it, but they would have just had a little better understanding of what those expectations should be.
Yeah, Tom, to your point, I think the biggest thing that I've heard from companies that have gone through a partial ESOP transition or a full 100% transition is that topic of just not planning soon enough. I mean, I think it comes down to succession planning in general, regardless of the ESOP, but it's the one thing that we always hear about. I should have started this 2 years ago, 5 years ago, or whatever that might be, especially if you don't have kind of those key people in place already that you're looking to transition the company to.
Yeah, and that actually brings up another point too, Chris. Thanks for jarring my memory here as it relates to how people are thinking about this and thinking about planning for it. I think a lot of folks look back and say it would have been better too if I would have maybe been willing to spend a little bit more time and money on things like quality of financial statements and all those types of things as well, as opposed to just maybe going along and getting compilations and a tax return. Well, maybe I should have been getting a review and or an audit sooner than later, in preparation to put me in a better place, when it comes time to do the valuation and really, have a better and stronger understanding of the quality of the information that's in my financial statements.
Yeah, those are all great points. I mean, I don't think I've ever been in a conversation with business owners that have gone through this process that have said they allowed the right amount of time to get where they were at closing date. It's always like it's way more complicated and it takes much longer than anybody ever thinks, because there are, to what you guys have all just said, so many parts that have to be considered in the whole process.
Yeah, and the one last thing I would add to that point too, Mark, is that the other thing that people kind of wish they would have known, they could do it all over again, is just how key they were going to be to managing all those parts. I mean, as the seller, as a current owner, I mean, it's really you that's engaging all these people, selecting all these partners, and and then herding the cats throughout this process and keeping track of everything and making sure everybody's on the right path towards close. So there's a lot of individual responsibility that falls on their shoulders as well.
Yeah, we've talked about this before. There's a commitment of time, and there's also a distraction from what are the regular, ongoing, daily responsibilities, typically of the owner,
right?
The primary owner. Diane, what are some of the benefits and disadvantages of an ESOP?
Yeah, so we've all touched on a few of those already, but I think the biggest one is going to be the tax benefits of the ESOPs, because depending on the type of company, type of corporation, you're going to get different tax benefits. One example would be company contributions to the trust are tax deductibles within certain limits. Another one is mentioned as well is that it can act as a mechanism to retain your top talent. The employees actually have ownership in the company and a share in the profits of the company. And so they're motivated to work harder and help, grow that company. They're a big part of it. Now, the disadvantages, we've mentioned that as well. The fact that the high cost of creating and then maintaining it costs financially and your time that goes into taking on this process. So you've got fees. Examples would be the lawyer fees, the trustee fees, your accounting firm fees. So there's a lot that goes into creating these ESOPs and maintaining them. Yes.
Chris, do the benefits and disadvantages vary by industry and or are other components of the transaction, such as number of employees or general size of the company, things that matter?
Yeah, there are definitely things to take into consideration. I mean, there are industries that are more prevalent, I would say, with going down the path of an ESOP. Professional services, manufacturers, those we typically see still kind of on that higher end of the scale in terms of companies that have gone through that process, but it's really across the board. We're seeing it more and more. I read an article recently where, contractors, for example, 3% of total contractors may have gone through, an ESOP conversion in the past. Within the last 8 years, that's transitioned up to north of 10%. So we're seeing it with more non-traditional type companies. Also read recently, we touched on the retention part of this, but as labor and staffing and just recruitment of young employees and people that are looking for something just a little bit more than showing up to work, for an 8 to 5 job, this can be a really good retention and recruitment tool. As it relates to number of employees, there's no set standard. I would say, under 20 is probably too small. It can vary, again, by the type of company. What you really want to make sure of is that you've got those, consistent, sustainable earnings. As you look back, you're going to want to make sure that you're doing the things that Tom talked about earlier. You're getting the right set of financial statements. You're partnered with the right people. There's certain thresholds related to an ESOP where you might not need a full-blown audit, for example, on the ESOP plan. But those are things that you're really going to want to consider whether you're above or below that threshold. Just, from a compliance standpoint and just overall record keeping, I think it's just a good practice, even though it can get expensive at times.
Tom, from the perspective of an advisor who has helped business leaders navigate the transition to an ESOP, talk about a few common oversights or unanticipated issues that sometimes are encountered.
Yeah, probably the biggest one was just the amount of time and the responsibility that falls on the person who's coordinating it. Typically the current owner, in terms of engaging the partners and making sure everybody's on the right page and moving the deal forward. The other thing that has come up from an importance perspective, again, in terms of, and then also even just understanding why you might do this, is just the employee education part of it. I mean, that's a big part of making these successful, is making sure that the employees understand why this is a great benefit for them and what's in it for them and how it all works and those types of things. And then too, the other part of it is what's really the goal here, because in some cases, a selling owner maybe wants to completely exit and get out of the company. I mean, that is truly their exit strategy. There's been a couple that I've worked with, it's been exactly the opposite, where the current owners want to stay in and want to stay, in control as it relates to running the company and kind of, things are relatively normal in terms of who's making decisions and who's calling stuff. Now, granted, you still have some of the changes that come along with the ESOP as it relates to having a board of directors and, kind of different reporting structure, but nonetheless, they want to stay involved and they want to continue to propel the company forward. So, I mean, I think that, as you navigate this, these are all things that you need to be thinking about and understand how that's going to work going forward and what you can and can't do and how it changes things.
Yeah, it seems to me that as we talk about this today, that this path really can't be done completely in a vacuum, that there really has to be a succession planning effort by the owner or the ownership group that is ultimately going to be the beneficiary of the sale, no matter what it is. Is that a fair statement?
I think it is, in part because, not only from a benefit standpoint as it relates to the employees, but, who's going to keep this thing going? Because to Chris's comment earlier about sustainability and consistent earnings, I mean, that's a big part of this because, remember, every year you're going to get an updated valuation as it relates to what the company is worth. And so obviously from a long-term benefit standpoint, for everyone's sake, you're going to want that valuation to go up every year, or at least over time, because that's what's in it for folks as it relates to, the value of the stock.
So when business owners are deciding between varying transition options, how do you suggest they approach this important evaluation process? And secondarily, what's the most important information they should have in that consideration? That's really to all of you, but maybe Tom, start with you.
Well, I think we talked a little bit earlier, but initially just doing an initial feasibility study and saying, does this even make sense? And understanding that they're going to need to make a financial commitment up front and early to understand that first and foremost. Does it make sense to move forward with this?
Yeah, and I would say, get your key advisors in the mix as early as possible. I think sometimes businesses are great about bringing maybe one party into the conversation, but I've seen the most success when everybody's in the room together, on the phone together, talking about how the pieces fit. And if the banker gets engaged too late in the process, that's just going to slow the matter down. So if we can start at the beginning and get everybody kind of on that topic at once, it's definitely helpful.
Mm-hmm.
Right. And Chris, that's a really good point, because it's also really dependent upon what's the financing structure of this going to be. I mean, is there going to be bank debt involved? Is it going to be 100% seller finance? What percentage of the company is going to be sold? Because you don't have to sell 100% of the company into the ESOP. But there again, that's all part of kind of that feasibility study and determining what's the real goal here and how do we maximize some of the benefits we talked about earlier, whether it be, the tax benefits and that type of thing, because at some point, if you're not putting enough into the ESOP, it's really hard to get a good ROI out of it as it relates to what your upfront expenses and your ongoing expenses are. So, I mean, I think that's the other part of it is just, what are we really trying to get?
Another part of this, folks, is the fact that you need to have a strong team internally, especially as you're wanting to step away, that you have the right people in place. I've had a number of companies start this process and realize that they have a controller in the CFO position, and they need to step the game up to continue to get stronger.
Yeah, that's a great point. The other thing I was going to say is that there are a lot of great experts, professional experts that operate in this realm every day, every week, all the time, both on the legal side and on the accounting side and on the expert information as it relates to ESOPs. We've touched on all of it, but they bring great value. And again, depending upon the complexity, depending upon the price, depending upon the leverage that goes into it, that whole entire team really is going to make for a much better process, a much better transaction.
Right. And you're right, Mark. And there's a number of different folks out there that I mean, this is what they do. And, they're ESOP specialists. And so when it comes to the, initial questions, feasibility studies, I mean, lots of times, they can give you some pretty good information pretty quickly as to whether or not, this is probably going to make any sense for you and ask some tough questions, to the potential selling owners. And again, what do you want to get out of this? Because to Chris's point earlier, which I think is a really good one, if you want to maximize the value of your company in terms of what you sell it for, ESOP may not be the best route to go, just as an example. But the other thing that we haven't talked about as it relates to the selling owners too, in terms of advisors is, they need to have their financial advisor involved as part of that group as well, because at the end of the day, in some way, shape, or form, they're going to be walking away with something. And that needs to be part of the consideration as to, what we do and how we do it as well, because there's going to be, tax implications for them and long-term implications for them that they need to be thinking about and planning for as well. That's
another great point. Well, this is a topic that's obviously very complex. We could talk about it a long time. We'd probably lose a lot of listeners if we kept going, but I know that we certainly could. Tom, Diane, and Chris, thanks for taking the time today to share your thoughts and experiences with our audience. And to you, our audience, thanks for listening to this conversation, and we hope you found this topic helpful. And should you consider an employee stock ownership plan, don't hesitate to give us a call. Also, let us know if there are other topics or information you'd like to learn more about, and join us next time on the First Business Bank podcast.
If you want more content like what you just heard delivered straight to your inbox, go to firstbusinessbankpodcast.com. And if you haven't already, make sure to subscribe to the First Business Bank podcast wherever you listen to podcasts. If you're listening on Apple Podcasts, please leave a quick rating of the show. Thanks so much for listening. First Business Bank, member FDIC.